Hello and welcome to our SB Talks podcast. Today is Tuesday, October 12th, and I am joined once again by our Mercurial Chief Investment Officer, Ashley Owen. Today we're going to be discussing Australian property prices, APRA regulations, Evergrande, market outlooks, and more. Welcome, Ashley.
Welcome all in the wonderful world of COVID lockdown. Good to see you all.
Gradually emerging. Prices have continued to surge this year, now breaching well ahead of pre-COVID highs. What should investors expect, if anything, the impact of the APRA tightening on lending regulations?
It's a good question to start off with. The housing price boom has continued, even with the lockdowns and the inability to go to auctions and the inability to go to inspections. There's just so much money floating around and so much very cheap money. You can borrow at less than 2% and lock it in for years. It's just so much free money around. It's hard to not throw money at property, and Aussies love property, so we're better to throw your money. So the property prices have rebounded, and I've got a chart in the report that shows how the property prices in all the capital cities are now pretty much above what they were pre-COVID, despite the lockdowns and the unemployment, etc. So that's to be expected, really. That's the intended aim. The intended aim of central bankers is to give money to the rich. Doesn't worry about renters, doesn't worry about the bottom third of society. Basically, it's the whole idea of QE and zero interest rates is to make the rich richer, which is great because we're in that bucket. But not for some, of course. The idea is that wealth will somehow trickle down in some sort of 80s fairyland world to the workers, because of
trickle down economics.
The rich get richer. You need more waiters to bring you food, but you can't go to the restaurant anyway, and you need more people to do the work. So it's a strange anyway. So central bankers have done that. So they've given the rich a free kick, which is great. So in our report last week, I think it was, I said, look, now's the time that the APRA, the central bank regulator, the bank regulator will have to start to put the brakes on the housing lending to stop the banks going stupid, as they regularly do. So, and literally one day after we published that last week, APRA came out with, lo and behold, some lending controls, which is no great surprise. So
they've done something similar to what they've done in the past in terms of the notional lending rate and affordability.
That's right. So back in the 50s and 60s, you had banks being told what to do. They were told what to lend, how to lend, who to lend it to, and at what rate. And they were told how to do their business. That worked reasonably well during the 50s and 60s. That was then deregulated in the 80s. They went mad, blew up billions, almost collapsed. Two of the banks were near insolvency. Westpac in particular. They learnt that lesson. They've become quite careful and overcapitalised since then. Banks hate lending to business because it requires half a brain, requires 3 neurons in close proximity to lend to business on cash flow. So they prefer to lend on housing. Housing requires less capital and no brain. So banks love lending to housing. So they just inflate property prices. So the lending controls were reintroduced back in 2014-ish. The speed limits and the limits on how much you can lend on investment housing and interest-only housing in particular, and again 2017-18 as well. And both of those lending control exercises did manage to bring house prices down, and they sort of ended that little bubble in 2014-15. We saw house prices slide because of lending controls, even though rates were still being cut, interest rates were still being cut. Again, in 2017-18, that also slowed the boom again. Then we had the 2019 sort of pre-COVID bubble, and then we had the COVID, then we had the rebound out of that. So we said, because now's the time for the APRA, the bank regulators, to start to put lending controls again. Next day they did, no surprise. It's probably only the first step.
Again, just pause for a second there. We're explaining what they've done and the impact that I guess that should have.
Well, this time around, they've started off, it's going to be one of the series of lending controls, probably over the next 6 months or a year or two, Meanwhile, the RBA is committed to keeping rates at zero for the next 3 years, which we can't see will happen, but that's his promise.
Yeah.
So that's the first one they've done, is that when you assess a borrower for lending ability to repay debt, the banks have now, when they took the controls off or reduced the controls a couple of years ago, they left the buffer rate. So if you're applying for a loan at 2%, the banks, the lenders must assess their income based on 2.5%, the 2% plus a 2.5% buffer. So they've got to assess the interest rates based on, say, 4.5%.
So the borrower needs to still be able to make the repayments should the rates go up as high as 4.5 or 5%.
Now 3 or 4 years ago, that buffer was like 6%, but now it was taken down to 2.5%, which is ludicrously low. So all the RBA, all the APRA the other day was to say that the buffer rate, i.e. the margin above the lending rate you have to assess income on, is now 3% above the lending rate rather than 2.5. So it's a tiny thing. So as an example, of the amount of money that can be borrowed. I went in the late 80s. I had an advanced bank. Remember those advanced bank? They were a building society turned into a bank. They were all gobbled up by the big banks. But I had an advanced bank mortgage, and it was $140,000. And then we did some renovations and added it. So the loan going into the rate hike period in the late 80s was $240,000. The rate was 13.5% initially, 13% interest on a P&I, a principal and interest loan. So every payment you're making a capital payment plus.
Over what sort of term?
That was 25 years, which is pretty long, very long in those days.
Yeah.
And we were mortgaged to the hilt, and the interest rate started at 13.5%, and the payments were about $2,500 a month. They went, and a couple of months ago in one of my reports, I actually put a copy of that advanced bank statement so you could see the rates rise. That went to 14.5%, to 15, to 16, to 17, and then finally in August-ish 1989, that went to 18%. And the payments on that were, the P&I payments, the principal interest payments were $3,640 a month. And I had a copy of the statement so you can see. So I borrowed $240,000, and it cost me $3,640 a month in payments, which was well over half of our net take-home pay. So it was horribly highly geared in today's terms back then. That was 1989. This year, early this year, my daughter bought her first unit in Sydney, and it cost, she put in a lot of cash. She put in about a third cash, so she had plenty of cash, and she borrowed $475,000 at 2% interest only. And the payments of those were $790 odd per month. So the point I'm making is that 30 years later, in today's artificial fairyland zero interest rate world, somebody can borrow twice as much as I did in the 80s, 475 versus 240. And it costs, in terms of monthly costs, the cost of that, with the borrowing twice as much, the payments per month were 1/5 of what
fraction.
they were.
Yeah.
The oldest.
I guess is the picture you're painting one of the sensitivity of the system to rate increases from here will be.
So that's right. So you answer the question, why are house prices higher now than they were 30 years ago? And the answer is because interest rates cost 1/5 of what they did to borrow money. So basically, if everyone had, if the banks were stopped to lend 100% tomorrow morning, like if there was no debt in the system tomorrow, house prices would be $200,000, $300,000, $400,000. Because of this mountain of debt, which is effectively free money, the house prices are now millions versus hundreds of thousands. So I remember about 10 years ago, there was an article I pulled out of the paper which listed about 50 suburbs in Sydney alone, suburbs in Sydney with median prices above $1 million. Now, back in the old days, $1 million was a lot of money. And there was an article that there were about 50 suburbs with medians, which means there's as many houses above as below, of $1 million. Now, last month, there was an article in the AFR that listed 32 suburbs in Sydney with a median price was more than $2 million. And we're talking ordinary sort of suburbs with shacks on them. The median price for a house in these suburbs, 32 suburbs across Sydney, was $2 million. So it's fairyland stuff. Will it end? Well, it won't.
Will it end, and how does it end?
It won't end. I don't think we'll ever see in my lifetime interest rates of 18% on mortgages again. So by the APRA, the regulator saying you've got to assess mortgages as if they're 2.5% higher, as if they're 3% higher than today. All it means is they're saying get your head around the idea of a 5% mortgage rate rather than a 2% mortgage rate, which everyone knows can't last. So there's a lot of people out there who have borrowed to the hilt, and they borrowed 90%, plus they borrowed the stamp duty, plus they borrowed the expenses, plus they borrowed the furniture and afterpay and all these funny things. So they've got no money, they've got no equity in the thing. And when rates go from 2% to 4 or 5%, which they will in the next 2 or 3 years, then a lot of people will be in trouble. Plus nowadays, people have got Uber jobs. They're not really jobs. There's no certainty. There's no tenure. There's no long service leave. There's no medical leave. There's no nothing. So the Uberization of work into the equation has created this added sensitivity that would otherwise not have been.
Yeah, so I guess you paint a picture of one where there's obviously going to be an extreme level of sensitivity to rate increases and therefore the impact that has on people's affordability. Obviously, the biggest factor that would hit the housing market would, should there be any significant increase in unemployment in the economy. So people can probably struggle through and pay the mortgage. If nothing else, they pay the mortgage at the end of the month.
That's right. So I'm very bullish on Australian property, particularly Sydney, Melbourne, maybe Brisbane. I like the big cities that are very diversified industries. I mean, there's no Detroit's. I wouldn't. I mean, I've lived in other cities in Australia. Lived in 6 cities in Australia and 2 in the US. I like Sydney, Melbourne real estate over the long term. Demographics is good. The structure is good. The supply constraints are good. So, as a homeowner meaning land, you don't buy airspace, you buy land with a box on it to live in and renovate. If you buy land with a house on it within 10, 15 Ks of Sydney, Melbourne City, you're not going to go wrong over the long term. As long as you don't buy in a bubble, you don't compete against yourself at auction and buy way too much. And as long as you don't have too much debt. Mm-hmm. So I'm very bullish on Australian real estate, which is underpinned by demographics, which is excellent in Australia, immigration, which is excellent in Australia. So that will continue after the COVID lockdowns are over, immigration will resume. And Australia has had, for the last century since Federation, the highest population growth rate in the world outside of Africa, which is very unusual. So it's beat India, it's beat China, it's been every other country in the world outside of Africa. Australia has the highest population growth rate. And largely that's due to immigration. So Australia's always
skilled migration. But so I guess you sort of said, given that strong economic backfooting, the skilled migration, and therefore and particularly in the central, I guess, economic hub of the country being in Sydney, Melbourne in particular. Yep. What would you expect for property prices in the next few years? You've shown charts historically where property prices typically in real terms shoot up and then plateau for a period of time and then repeat. Yep. Is that still the case, or do you think that trend might be broken somewhat?
Probably. I like looking at real prices because real takes away the impact of inflation. So if you ask why your granny bought a house for £3,000 in 1932, well, most of that's inflation. So if you take out inflation, you end up with the real cost of housing, which does go through great bubbles and then stays flat for a decade and rises again and goes flat for a decade.
In real terms.
Going back to the 80, I can remember walking down the street and in a 2-year period from 88 post-crash, 87 crash, all the money went into property. From 87 to 1990, house prices doubled literally every year. And you could smell it when you walk down the street. We bought and sold houses in that era. We're in a period, and then rates rose to 18%. That killed it all in Keating's recession we had to have, and lenders went bankrupt and all sorts of things. This time around, we're in the same period. Free money era, easy to get a home loan, plenty of lenders around, not just the banks, plenty of other lenders around. So I can see, as long as you buy well, don't go crazy at auction and compete against yourself and compete against other FOMO type buyers. And as long as you don't have too much debt, then longer term, as long as you're not a forced seller, where people get into trouble is they're forced sellers. They've got too many properties. Or they've got they can't afford it, unemployment's higher, the business folds. So a big recession like we had in the early 90s, we haven't had a recession since then, a real serious recession. Early 90s was one, the GFC was another. People lose their ability to pay off their mortgage, and you don't want to be a forced seller in that environment. So if you can avoid being a forced seller, then property long term is a very, 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 very good place to be. So Sydney, Melbourne, Brisbane, pretty hard to go wrong.
But do you expect, probably, let's say if we look over the next 5 to 10 years ahead, that the property market, given the run that it's had over the last, call it 10 years, but even it's come in bursts, that it's hard to sustain these sort of double-digit type growth rates?
So it comes down to inflation, and this is where it all ties back. Currently, the rhetoric in central bankers around the world has been, we're in a low inflation environment. It's a demographic thing, aging populations, changing structure, Uberization of work. We're not going to have inflation for a long, long time. And we've seen inflation around the world is running at 3, 4, 5%, but that's only really coming out of the dip last year. So inflation, the longer term, all of those numbers we're seeing now, the headline rates are 3, 4, 5% in Australia, US, Canada, New Zealand, Norway, etc. They're all just the other part of the curve coming out of the dip. So central bankers have said that's temporary. That will not be continued next year, and we're already starting to see inflation. Those annualized numbers come off. It's gone from 5s to 4s and 4s to 3s. So we see that in Australia as well last month. So that's playing into the argument that inflation is lower for longer, and therefore we're not going to see rate rises for a long time. And when they are, it's not going to go to 5, 6, 7, 8%. It may well settle at. Normally, the rate of interest rates in a society should be around about the nominal growth rate of the economic pie, nominal GDP, which is about 4 or 5%. Central bankers have been saying that rate is lower, so probably cash rates in an equilibrium world should be around about 3-ish or 4%, perhaps. And they've said inflation that we're seeing is temporary. The problem, that argument has started to unravel over the last month. They're finally waking up and saying, whoops, it may well be. Now, inflation is a basket of things. Everything you buy, housing, travel, train fares, mortgage, rent, is all in the inflation basket, and they measure that monthly, quarterly in Australia, but we measure that and we republish that. So the inflation basket is everything you buy on a daily basis in Australia or whatever country you're in. Central bankers, there's only 2 important things in inflation that affect people's livelihoods. That's cost of food, putting food on the table, and the cost of energy, turning the heater on or getting in a car. So for some unknown wacky reason, central bankers don't look at the CPI number. They look at core inflation or underlying inflation, which strips out food and housing and energy costs.
Because they're too volatile.
Well, because they're too volatile. So when they look at their Ouija board and work out how to put rates up and when and where, they look at the core inflation, which deliberately ignores the things that affect people most, food and energy costs. So you've got energy costs in the US, which rose like 50% last year. Food inflation is through the roof, mainly because of supply problems with COVID and floods, etc. So there's quite a lot of things going on to make food prices go up. And of course, the same sort of things going on with energy. Oil prices, for example, are now $80 and they were $20 last year. Actually, they're minus $40 last year in April. So inflation for food, which is important to people, and energy, which is important to people, the ability to switch on the heater on the wall, going into summer in northern part of the world, it's going to be very, very damaging. Central bankers have said, well, we'll ignore that really, and we just worry about core inflation, which ignores the whole problem. So I think over the last month, we've seen central bankers say, we might have got that wrong. We might have to worry about food inflation and energy inflation, which is actually what costs people money to sit down and eat at night and turn the heater on and turn the TV on. That may well cause a couple of central bankers to say, well, we might have to go earlier and a bit harder, whereas our thought over the last 6 months has been central bankers are asleep at the wheel. They do what they almost always do, is they leave it too late. Then they say, holy hell, they'll have to go too hard. So you end up with rates rising much too hard at the end of the boom. So I suspect the RBA in Australia has still said that they will not raise rates until 2024, which is another 3 years away-ish. They're pegged 3-year rates at 0 till 2024, April 2024. They've said they're not going to raise a cash rate till 2024. if they do stick to that plan,
seems increasingly hard that is the line that they're going to be.
They'll be the last central bank in the world to do that. Meanwhile, they've said to APRA, it's all too hard. You figure it out. You go and stop the banks lending mad. So APRA, being the Australian bank regulator now, since it was stripped off, RBA buggered it up, so that was stripped off them 20 years ago. So APRA is now the bank regulator. So APRA is going to do the job, the hard lifting for stopping banks doing stupid things. So they'll start to, in 2014 and 2018, they had things like they limited the volume of lending growth. Banks couldn't lend, their lending growth couldn't be more than 10% per year.
With restrictions on the composition of the book between homeowners and investors.
Lending, the interest-only lending, the amount of interest-only, the investor lending. So that was the last boom we had. The hot item was investors lending on interest only.
Yeah.
Nowadays, it's tipped into more owner-occupiers, people who rented for years and said, well, I can borrow money now at 2%, I can do it. So it's the owner-occupier market, which is the hot market now. So they're affecting. So I can see APRA over the next 6 months introducing more lending controls for banks to try and slow the boom down.
You're painting a picture there. If it's, you're sort of crossing over between property and inflation here, but you're sort of painting a picture also with the RBA theoretically trying to maintain rates ultra low for quite a period of time, that inflation is more likely to creep in.
Yes, I think inflation's already there now. But the question is it temporary? Will it reduce down to 1 or 2% again over the next 6 months as we come out of the dip from last year? And the answer is, if you ignore food and energy, which is fairyland stupidity, then you're probably right. But all it counts to people is the ability to eat and the ability to turn the heater on. And going into northern winter, it's going to be tough to maintain that. So I suspect the Fed in the US, which is the important one because that drives markets around the world, the Fed has started to scale out of its QE program. It's $120 billion a month of assets it's been buying, which is good. The Fed has said that they will scale out of QE before they start to raise rates. Last time it took them a couple of years, 2015, 16, 17, to scale out of QE and then start to raise rates. And they raised rates all the way through 2018, which killed share markets temporarily. So they stopped that and reversed that in 2019. So I can see that central banks around the world, we saw New Zealand last week, Norway, Brazil, Paraguay, a whole lot of countries now have started to raise rates. If Australia sticks to its plan of being the last one to move, I suspect it will be too late and it'll have to go too hard again. It won't be 18% rates, but you may well see 3, 4, 5% interest rates in the next 3, 4, 5 years, which will mean a lot of borrowers are overgeared and highly.
It's a big shock to the system if you've been borrowing at 2%. It depends on the length.
2%, and you've got a 2-year interest-only loan. You've suddenly got a 2%, and in 2 years' time, you've got to refinance into a P&I loan, a principal interest loan for 25 years at 4% or 3%. Your repayments will double. And if you do that on one property and you've got a job, that's fine. But if you've got 3 or 4 you bought off the plan somewhere, and all of a sudden you've got to settle on these things and you've got to double your interest repayments and you can't afford it. You're a forced seller, and you don't want to be a forced seller in any market, let alone a slowing market. Yeah.
All right. So I guess what happens for the property prices over the next 5 years, there's a couple of big levers there in terms of 1, inflation, and 2, interest rates.
Yeah, but I think immigration will come back. The good thing, good being good for house prices, the good thing is
fundamentals.
A lot of construction has stopped in Sydney, Melbourne, Brisbane because of the COVID lockdowns, the inability to get labourers. You can't get people to pick fruit, you can't get labourers, you can't get anybody. So that has stopped construction or slowed down construction, which is good for supply constraints, good meaning good for prices. Immigration will return, people will come back. I can see a lot of people bailing out of China, Taiwan, Hong Kong over the next sort of 5 years. So you can see immigration, a lot of good reasons for immigration to come back very strong, all of which puts pressure on house prices with supply constraints. So medium term, long term, I've always been pretty bullish on housing in the big capital cities, and you can't really go wrong as long as you don't pay too much in the wrong part of the bubble, and as long as you don't do it with too much debt. You're not a forced seller.
All right, beautiful segue. We spent a bit of time last month discussing the situation in China, obviously increased Xi Jinping sort of increasing his control and the hand of the state over most things, and in particular looking at the construction sector and the unfolding Evergrande situation and concerns over whether they fold and whether this is, China's Lehman Brothers moments, been further developments since we last spoke on it?
Yes, I think I spent most of the last report on the Evergrande and the housing because they're related. China's growth over the last 20, 25 years has been phenomenal. They've lifted 1 billion people out of poverty. They've taken more than 600, 700 million people now from farms, little villages, Soviet era factory towns, and they put them into nice new blocks of flats in cities, mainly on the East Coast. So the urbanization of China, all built with Australian rocks, has taken place, phenomenally changed human society as we know it, because that's driven commodity price booms and mining booms and everything else that's built in China and made in China. So it's changed the world economy dramatically over the last 20 years. Australia's been the major supplier of rocks to that development, which has been tremendous for rock diggers. And that's trickled down to, it's been the biggest contributors to tax revenues in most governments and federal government as well. So it's been a bit bonanza for all Aussies, like it or not. That growth has been built with Chinese construction, building blocks of flats, houses, cities, train stations, airports. Is basically concrete, which is created with Aussie iron ore and steel and rocks and coal. So that growth engine now, the problem with that is that, Xi Jinping has been trying for the last 5 years to shift the economy from a construction-led growth path to a more developed world or more Western type growth path, which now in Australia, New Zealand, and the US and New Zealand, Canada, the rest of the developed world, 70% of its GDP growth comes from household spending.
Yeah.
So household spending is a driver on debt as well. So we're all indebted to the hilt. So that's the downside. But so China's been trying to get off the treadmill of construction led growth, to get into a more consumer-led society where household spending, Chinese households are savers, they don't spend for a whole lot of structural reasons. So Western households, Australian, US, UK, European, are spenders and borrowers, whereas the Chinese have been investors and savers. So the growth's come from construction. The problem with that is that this great GDP growth they've had over the last 20 years, industrializing, building cities, is they've got this massive oversupply of construction. So there's something like, nobody knows, but something in the order of 50 to 100 million units, apartments, excess supply. So the metropolitan vacancy rate for housing across China is about 21%. So 1 in 5 things you see, blocks of flats you see, is empty for a whole lot of reasons. The developer's gone bankrupt, or they've just been completed and left there, or the city hasn't been moved into yet.
Yeah.
So you see on YouTube, you see them blowing up whole suburbs full of buildings because they're just vacant, empty blocks of flats, unconstructed, uncompleted. So every time he's tried to do that, it's a good aim to try and get off the construction bandwagon, which is leading to oversupply and distortions, and get onto a more consumer-led society with consumer spending, which is more like most other countries in the developed world. That's worked well, except for every time there's been a slowdown, like the GFC, like the virus recession, like the commodities collapse in 2015-16, every time there's been a slowdown for whatever reason, the instant go-to mechanism is to increase construction again, because that's the
number one injection into the economy.
Build a new city, creates jobs, people are happy, people are off the streets, they do something for a while, and then they end up with an empty city, but it doesn't matter because the people have been employed in the meantime. You move on to the next city. So that's always been the go-to policy tool for China, to increase construction again. So you look at last year, they were going down the path of trying to consumerize society. COVID hit, lockdowns hit, got to get 1 billion people back to work, build a new city somewhere. So it's been construction-led, not just cities, but things like all the military islands are building, the airports, railways, tunnels, bridges. You see all these vast constructions in China, and it's all built with Australian rocks, but it's all largely done to employ people with no real output at the end, i.e. bridge to nowhere, tunnels to nowhere, cities with nobody's in it. I'm exaggerating a bit, but that's the nature of the problem, to try and get off this construction bandwagon as a policy tool to solve everything, to try and get into more sustainable growth. dare I say it, he's trying to make it look more like a Western economy, but he's desperately anti everything else Western. He's anti-free speech, he's anti-voting, he's anti-dissent. So he's trying to very much control what people do think every day, but still create the idea of some sort of consumer-led economy.
Western-style economic growth.
It's got a high risk of failure because you get unrest. As soon as you try to do some reforms, you've got a high degree of unrest. For example, over the last 3 or 4 months, you've got every town in China, every city in China has got a whole bunch of things that in other countries have gone years and years and years ago. Chinese steel mills. I've been to Bao Steel, which is Baoshan, which is up the Yangtze River. I went up there one day to look at where our steel goes, our iron ore and coal goes. I went to Baoshan, which is the largest steel mill in the world. It creates all the steel for car makers, and it's flat panel steel. So everything that's made out of steel, fridges, air conditioners, cars, are made in Baoshan, which is the world's biggest steel mill. They have probably 1,000 steel mills, albeit smaller, all over China, which are horribly inefficient and are kept alive by refinancing forever, kept alive purely to keep jobs in the town and city they're in. Over the last 6 months, you've had edicts from Beijing saying, we want 30-ish% of those steel mills to close, A, because they're inefficient, B, because we can't afford refinancing them forever. You've got these massive debts all over the place in the state banking system. And C, the other important reason is they belch out carbon and
emissions.
So in an attempt, and Chinese have done a very good job into reducing carbon emissions from closing down inefficient industries like steel. That's what's really hit the iron ore price and coal export. At the same time, you've got China banning coal imports from Australia last year. This time a year ago, they banned coal imports. So you've got this massive energy crisis in China and around the world because they've banned Australian coal imports, and Australia's the #1 coal exporter now in the world. So you've got this massive problem with collapsing iron ore prices because the infrastructure boom and the China's going through a slowdown now for 3 or 4 things going on there. And you've also got the banning of coal imports, which means they're desperate. I think last week, for the first time in a year, Beijing said, we don't care where you buy coal from, get it from anywhere and pay whatever just to keep factories running because they had blackouts. So I think Australians are now starting to ship some coal from Newcastle to China under the radar because China is just so desperate. All of which is pushing up prices of everything. If you order something online 6 months ago, you get it within 3 days. Nowadays, you wait 3 months because the supply chain has been stopped by blackouts because of the massive energy crisis. So that's coming back to interest rates. When energy prices rise, they double or rise 20, 30, 40%, which they are around the world for a whole lot of reasons. Supply constraints, oil, coal, every country in the world, apart from Australia, although Adelaide is good at this, every country in the world, a developed country, China, all through Asia, in Europe, they're having blackouts going into what's going to be a cold winter. So you're going to see central bankers start to flinch and say, well, maybe where inflation is running out of control sooner than we otherwise would have thought.
Yeah, so when we talk about Evergrande, you set the scene. China, obviously, the big challenge they have is trying to create the outcome they want and manage the potential for unrest. So always with one eye on the potential for unrest. So hence, in the past, if there was an economic downturn, we worry about people being out of work because that's going to lead to greater levels of unrest. Hence, we turn to the old playbook and roll out some more roads and cities.
Yes.
And last month, you sort of painted a picture where, because of that fear of the impact of unrest and trying to maintain, I guess, an authoritarian regime, means they're more likely to do whatever it takes to stop Evergrande going particularly south. Yeah,
Evergrande's funny. I spent a couple of articles on that last weekish in the monthly report. It's a funny beast. It's one of these things. There are 3 big construction houses that build all these cities in China. Evergrande is one, which is a Guangdong-based 20-year-old company built by a billionaire. It's got construction all over China. One's called Vanke, which is listed in Hong Kong, and one's called Country Garden, which is also listed in Hong Kong, listed companies. And there's dozens of others, but they're the 3 big ones. Now, they're run by billionaires and public shareholders. They have been at the forefront of this construction boom over the last 20 years. Now, Evergrande, for example, and they've got layers upon layer upon layer of debt.
Yeah.
Evergrande is there. I looked at their annual report the other day. They've got around about $300 billion US of debt on about 10 different layers. It's a severely of debt. They've got 800 construction sites around China. 500 of those have been boarded up by suppliers who haven't been paid. So of the 300, I go through the $300 billion of debt and say where it is and who's it's owed by. And I go through one by one and saying, well, in a normal world, you have a ranking of a hierarchy ranking of who gets paid when out of the proceeds of a liquidation. And I've suggested, I'll go through one of those one by one. I've suggested in this case, it'll be politics that decide that order of ranking, not legal ranking, because there's no rule of law in China. It's whatever Beijing wants goes. So they will choose who can afford to take the losses and who they are happy to bail out. Now, Evergrande as a company has borrowed about $20-odd billion US from global markets in US dollars. It's offshore bonds. They probably rank last, even though they're very high ranking in security, they will rank last and they will be the first to go because Beijing will say, we don't care about foreigners, they can take a loss. And that's the way it'll turn out. So you look at their bonds trading now, they're trading at like 10 cents on the dollar because you'll lose your money. We don't have any in portfolios, fortunately, but people around the world are chasing yield, have bought these Evergrande bonds for yield. High risk of loss, they'll lose their money. They've got about another $10 billion of onshore bonds, which is institutions and bondholders in China buying in renminbi. They are probably also going to lose part or all of their money, even though they're very high ranked in security. There are about $100-odd billion of suppliers who haven't been paid. This is plumbers and architects and labourers in these building sites. You can't not pay those people out because they will riot in the streets.
Yeah.
There's about 1.5 million units. When you buy a unit, you pay a deposit, which in China is about 30-40% deposit. You pay the property developer a deposit of say $100,000 Aussie dollar equivalent for a $400,000 house or unit. That money, that $100,000 per unit that 1.5 million Chinese have deposited, that's an unsecured debt. That's a very low-ranking unsecured creditor on their balance sheet, and you can see them on the balance sheet. China will not allow those people not to get their houses or their deposit back. So there's physically no way on earth they're going to let 1.5 million ordinary Aussie or ordinary Chinese lose their shirt in a development that collapses. So they will not lose their money. So where will the money come from? It will be a very similar, and I list out, I think, 3 bailouts that China's made over the last 12 months, which are quite good precedents for how you deal with this sort of problem. And the answer will probably be, and you've seen a couple of steps happen over the last week, the answer will be Chinese government will take over. We'll say, thanks very much, we'll take your company, billionaire wiped out, don't care. And we've seen that happen many times over the last year alone. Yeah. They will pump in more cash. They will keep people employed. They will complete the 1.5 million units. They'll open up the 800 sites, 500 which have been closed, complete the units. People get their unit. They get their unit. They don't lose their deposit. They don't lose their unit. And people will get paid, suppliers get paid, and the banks, who are all government-owned banks, everything in China is government-owned or government-controlled, the banks who are the major secured lenders will also get paid because the units will be completed, people get their houses, they move in, pay the rest of the deposit, and the money goes back to the bank. So the only solution really is for China, the state, to take control, as it's done many times in many examples I've listed out. And they will decide who wins and who loses. Foreign shareholders don't care, foreign bondholders don't care. Local investors, they will probably let a few of those go as well, as long as the unsecured creditors, the depositors on the units, and the suppliers get paid. There's another little class of investors called WMPs, weapons of mass destruction, wealth management products.
Right.
So in China, it's you don't have many choices as to about what to do with your money. So housing is very popular in China for investing because you can't buy overseas shares, you can't buy overseas bonds, you can't do anything else but put your money in the bank. And you can buy things like, every now and again you have a bubble in garlic or a bubble in tulips, all sorts of things they get bubbles in because they've got physically nowhere to put their money. So the banking system in China is controlled by the bank, controlled by the government, and they have artificially low rates on deposit in order to gather deposit money cheaply into the Chinese bank so they can lend it on cheaply. So in order to get around these very low regulated deposit rates in banks, a lot of companies, thousands of companies, including Evergrande and many, many others, have issued like a unit trust. They've issued a trust they call wealth management products, and they're basically a trust, like a cash trust, which pay around about 5, 6, 7, 8%. They dress it up like a deposit, and they
it's like the private debt market here in Australia that's quite popular in recent times.
It's a non-bank deposit market, and it's like a cash trust, like Macquarie's cash trust, but that's actually cash. These cash trusts are dressed up as cash trusts, and they're paying 5, 6, 7%. They are an alternate method of borrowing money from by developers and other companies like Evergrande. So they've got around about it's hard to tell, but probably 20 or 30 billion dollars in depositors' money taken through these wealth management products, which have been sold through bank branches.
Sold domestically to Chinese.
A lot of staff have these wealth management products. A lot of Evergrande staff. A lot of Evergrande suppliers have been forced to buy these products in order to get supplier contracts, plumbers contracts. So there's a lot of people, probably 50, 100,000 odd people who bought these trust products, which is like off-balance sheet finance from companies like Evergrande. And if you look at what was happening in YouTube over the last month, as those companies, and Evergrande's the biggest one, started to teeter, there have been riots in the streets these are the WMP, the wealth management product depositors, who thought
wanting their money back.
So they're off balance sheet. So they're probably the lowest ranked of a lot. But I can see Beijing saying we're not going to have what are mums and dads mainly buying these, $10,000, $20,000 unit trust products, expecting to get 5 or 6% interest, even though it's frowned on because it's outside the bank regulated system. I suspect the potential for riots, and we've already seen them on YouTube, the potential for riots there is quite high. So it's a ranking of who gets paid in this not liquidation. The government will take over and control it and sell bits off. They've been trying to sell off their subsidiaries,
but don't necessarily expect normal rules to apply. Yeah,
there's no rule of law. There's no normal rules. So I suspect the government, which control now. The point I make is the government controls everything in China. If it doesn't control it directly, it controls it indirectly. You don't do what they say, they put you under a bus. For example, Huarong, Huarong, which was one of the bad banks they set up. It's a major lending institution listed. That was one of the bad banks set up in '99 to take off the bad debts of the good banks that went bankrupt and had to be recapitalized. So Huarong was one of the two major bad banks, which it had a bunch of assets, billions of assets, and its job was to refinance the assets to try and keep these failed businesses alive forever. They went outside their mandate, and they bought all sorts of wacky investments all over the world. So Beijing said, stick to your job, do what you're told, or we'll round you up. So the chairman of Huarong, who's a Communist Party stooge for years and years and years, he was charged with all sorts of wacky offences, probably trumped up, who knows. He was rounded up, charged, convicted, executed all within 1 week in January, like executed, i.e. dead.
Yes.
This happens, and it happens all the time. So in China, everything's controlled by Beijing directly or indirectly. Even Jack Ma, Pony Ma, the billionaires that own Alibaba and Tencent, they do what they're told, or they're rounded up and locked up, as Jack Ma was for 3 months last year. So the good thing about state control of everything is that in a crisis, you can actually decide what to do on a weekend, tell everyone what to do on Monday, and they go and do it. They don't do it, we shoot you. And they know that. So things get done. India is the reverse. India's a democracy, and everything is 30 years behind because they're still fiddling with all these little parties. So India is 20 years behind China, primarily because India's a democracy. People have a say. Good thing normally, but in a crisis, you want a war room situation. And the good thing about China is they control everything. They work out what to do on a weekend. Go to the Great Hall on Monday, you do it or we shoot you. So Evergrande will be sorted out by state control. It'll be taken over, and the buildings will be built. People will get their deposit money. Lenders will get their money back out of the sales when they get completed and sold. Suppliers keep their jobs. Wealth management investors, product investors probably will get, maybe they'll be on time payment to get
most of their money back.
They get most of the money back in time. Local bondholders will go. Foreign bondholders will go. No, there's no interest in China in saving anybody foreign, so they'll lose their money. Not a big deal. We don't have those in portfolios.
So last item, Ashley. Just conscious of time, but
that's the Evergrande story.
End of quarter, and September a little bit weaker for shares, particularly more commodities over other sectors for the reasons that you touched on before. But what do you see in the outlook ahead?
It's very hard to fight the Fed, and what we said, we've been quite well. Our models have been quite bearish on the outlook for shares for 2 quarters now, and we've said we understand what that's doing and why, but it's very hard to fight the Fed, and the Fed has been, which is that's the interest rate path, which is probably the most important determinant of economic growth and asset prices is interest rates. And what drives that is inflation and inflation perceptions and how central bankers perceive inflation. So it all comes down to when the Fed will start to raise rates and why and how and when. And we see that being a free money bonanza for certainly been good this year. Shares had, I think in Australia, had 11 months in a row of positive returns, which was a record since 1943. We said September will break that, and it did, because all the big dividends have dropped the share price, which is fine. They pay a dividend. Fortescue paid a 10% dividend. It dropped 10%, dropped more than that. Iron ore's down. Most other commodities are doing very well. Coal prices have tripled over the last year because of the constraints in China, which has rippled around the world. Most other industrial metals are doing very well as well. So we're into a commodity cycle, albeit ups and downs on the road, but we're into a big commodity cycle. Energy revolution, AI, robotics, clean energy, lithium, cadmium. We're into a major commodity cycle again. Iron ore is down, but tripled a couple of years ago because of the Vale mine disaster. So iron ore's done well. Iron ore price is down now to where it was. It's still higher than what it was most of the last 10 years. So I think commodity prices are okay. Demand's okay. The question mark will be how the inflation numbers start to scare central bankers. I suspect it'll be okay. Meanwhile, you got up and down with Evergrande will come and go, but the big picture is really interest rates remaining low for several months yet. So that's all bullish for share prices. Again, as long as you don't pay too much in a bubble, and as long as you're not a forced seller.
Excellent. Oh, well, end of quarter, we'll review asset allocations and write and communicate on that in the weeks ahead. But for now,
yep.
Thank you very much, Ashley.